Hello, this is Ahura and I'm here today to show you two secrets that they can help you always to win in the financial market. So stay with me and let's check them out. In the financial markets, more than 80 or 90% of our job is to manage our psychological situation and our funds. The fund management is contained of two different subjects. We have two different subjects in the fund management. We can say that money management and risk management together, they are the tips that they can help us how to manage our funds and how we can use the best opportunities of the financial market, the best opportunities that we can have with our capital. About the capital and how we can use our capital, I have a rule for myself that I'm using that for many years. You can follow that, you can at least test it, and if you get the answer, if you get the result out of that, you can try it always. I'm doing that more than 10 years and I can tell you that they are very useful. First of all, whatever you have in your, whatever the fund that you have for investment, for trading, let's go, I'm talking here right now about the trading. Whatever the money that you have, the capital that you have for trading, save 75% of that in your wallet that you are not trading, and just move 25% to your trading account where you are trading, where you have the open position, where you want to open a position, a close position, and do stuff like that. So 75% is to save your money. Why we have 75% here to saving? I will tell you. And then we have 25% for trading. This 25% is for open the position, to buy or sell something, that whatever we want. So 75% in our wallet, 25% is going to our trading account. So if, for example, we have $1,000, just like example, it means that $750 is for saving account, and we have $250 for trading. Oops. 250 for trading accounts. So, and when this money, the $250 we have for trading, is again, we can divide it to two different parts. 75% for trading, for opening the position, and 25% for opportunities. What means for opportunities? For example, let's say, for example, here we have $1,000, $750 will go to our saving account, $250 for trading account. So $250, 75% of that is be $100, almost $80, right? $180 is for trading, and $20, $50, $70 for market opportunities. What does it mean? $180, so whatever you want, any position that you want to open, you don't have $1,000 anymore in your account. How much you have? $180. And when you have $180, $250 for trading, and from this $250, $180 you have for opening and closing the position, for opening any position. This $70 for what? This $70 is for market opportunities. For example, you have, let's say, just very interesting example I'm telling you. For example, you have US gold. You bought the gold from at the price of $1,750. You know that the gold and USD JPY curve relation is up. They have opposite relations. For example, if gold is going up, USD JPY is going down. For example, you have a buy position in the gold, and gold you have a buy, you bought the gold, and in few hours you can understand that, for example, you're in a position, for example, it's going so close to your stop loss, and then from there you want to reverse, just not touching the stop loss, but again after falling $10, $15, for example, from that deep price want to get back and go up. So the price is down and now it's going up. At the same time, you have the USD JPY. When it was going down, it was going up. Your USD JPY was going up, and now it's going to return as the reverse to the gold movements. So when you use the JPY want to go down, you have $180. You open the position with $180. You tell yourself that, oh, you see, man, if I had free money, if I had a free margin, I could sell USD JPY at this price, at this level, because it was better to sell it at this level than selling at this level. So this is the opportunity. For example, this, or at the same time, you can see another opportunity in USD COD, or at the same time, you can see opportunity in the oil market. These opportunities that you see in a market and you want to take the advantage of them, you want to use these opportunities. What you can do, you can use these $70 that you have for opportunities. You saved here for opportunities. And why we are talking about saving $750 here? You know, we always say in a market that as long as you are in the market, you have the opportunity to win. So the main aim in the market, our main aim in a market as a trader should be to stay in a market, to stay alive. We don't close our accounts. You know, if our account will be closed, if we are out of the money in our account, so if we don't have money in our account, in our trading account, it means that whatever deposit, if you don't have money in your account, any opportunities comes to your side, you cannot use them. You can use the opportunities when you have the money, when your account is active. So keep your account active. How you can keep your account active? You can have always 75% of your money as a save account. That even if you lost all these $250 here, still 3 times you can go same way. So once already you went and you lost. So you have 3 more chance to try this way again. It means that you have 3 times more chance to win than if you want to use all your accounts. So I'm doing that always. So if you, for example, if you don't follow the rules and just go to open a position with all your capital, and if you do the mistake and you lose your account, it means that you don't have any money again to start trading. But with this, you have again 3 more times. 3 times more the chance to go and try all of them again, and you will have another opportunity to win in the market. This is the secret that I am doing that for more than 10 years, and I'm so glad that I found it. This is the experience that I got. You can use it, and I believe if you follow the rules, you never lose your account, and you will always have money in your account to recover your loss. So this is the chance you have to recover your loss. This part was the capital management, how you can manage your money, how you can manage your capital. Let's go to the second part, how you can manage your risk. So the second part is the risk management. The title of risk management has too many different subtitles. One of those important subtitles is lot size. It's finding a correct lot size. Finding the current lot size is one of the common mistakes that too many traders they do. Traders, they do the mistake. They go first and select their lot size, and based on the lot size, they're trying to find their stop loss, where they can put their stop loss, which is 100% mistake. First, you need to find your stop loss. Based on your stop loss, you can find your lot size. Because market doesn't care about your money, market doesn't care about your capital, market doesn't care about your lot size, but market does care about the K levels, about the support levels, about the resistance levels. So find first your stop loss, how many pips you want to risk, where is your stop loss, how many pips is your stop loss, and based on the stop loss pip numbers or pips, you can find your lot size. Let me give you the example. For example, you want to trade Euro USD and your capital is $10,000. You have $10,000 as your capital, $10,000, and you want to risk 1% in this position. This is your risk, 1% risk. Or I can put it here. 1% you want to risk. You have $10,000 in your account. And the stop loss that you found based on the support and resistance levels or based on the other techniques that you do have, Your stop loss pips is 20 pips. So your stop loss is 20 pips up or down from your entering level. If you want to buy, your stop loss is 20 pips down. If you want to sell, your stop loss is 20 pips up, for example. And then you have to find the pip value. If you are trading Euro USD, the pip value of Euro USD is $10. It means that each pip of Euro USD is equal with 10 US dollar. So 10% multiplied by $10,000, it means it is $100, equal with $100. So 10%, 1% multiplied by $10,000 is $100. And then 20 pips you have as your stop loss, and each pip value is $10, so it is $200. So $100 divided by $200 is 200. 100 divided by 200 is 0.5 is your lot size. So you have 0.5 lots that you have to select. If you have $10,000 in your account and you want to risk just 1% of your capital, and with 1% of your capital, your stop loss is 20 pips far than your entering level, and each pip in the symbol that you are trading costs $10. It's equal with $10. So each pip value is $10. 220 pips by $10 multiplied by $10 is 200. 1% of your $10,000 capital is 100. 100 divided by 200 is equal with 0.5. 0.5 is your correct lot size. This is how you can find your correct lot size, and this is how you can manage your capital. Hope it was useful for you, and hope you can try it. First try it before go forward. First try it, and if you find it useful, you can have it with yourself. This is my experience that I always was happy using this system or using this strategy. Thank you so much. Thanks for your attention, and hope always you're having a profitable trades.